Welcome one, welcome all to The Node, brought to you by DeFi Crypto and Airdrops and DeFi University. I am Mike, aka Veteran Crypto, and with me as always in the mornings or afternoon, depending on where you're at, or evening possibly, is David from DeFi University. How's it going, brother?
Outstanding, Mike. Doing well today, man. Watching, Bitcoin on my other screen here, just watching Bitcoin, ETH, Sol, the entire digital asset space move a little bit lower this afternoon. S&P and NASDAQ off a couple of points and having a good day, man. Yeah.
Nice. Well, let's go ahead and jump on into the news because I want to squeeze in a lesson here at the end. So let's pop on over to here. So I wanted to get your input, and we were talking a little bit before we went on air, and you were saying that I guess your mom had been asking about this. So I ran across this, and it's a Strategies STRC. It says it's perfect for yield-seeking retirees. STRC, or I guess you said that Saylor calls it Stretch, pays monthly cash dividends, monthly, at an amazing 11.25% annual rate. STRC maintains stable share value near $100 a share, so retirees don't need to ride out volatile swings in their principal. STRC's dividend payments are tax deferred. You pay no tax when you receive dividends. So potentially, I definitely do your own research. Do your due diligence. But potentially, this would give you monthly income. Retiree income. So a 10, 11%, that's strong, especially, that's kind of my understanding in traditional investing, in TradFi, that if you were making, 10% a year, that was considered a very strong, rate of return. So what's your thoughts on this, David?
Well, so the first thing that comes to mind is what is the true rate of inflation? Like that's the first thing that comes to mind. Like what's your real yield on that 11%? It's a little bit lower than that just because the dollar's depreciating, but 11% is that's like mortgage REIT type yield. There are a couple of real estate investment trusts that pay monthly dividends and they pay an APY of like 10, 12%. I think the biggest of them is like Annaly, NLY. Also, my uncle's old company, MFA, they pay a similar dividend to that. Dude, 11% paid monthly. So it's not paid monthly. It's 11% APY, but then that dividend is paid monthly. That is a phenomenal rate of return in TradFi. Mm-hmm. But here's the thing. I did a little bit of digging on how that yield is actually generated. And if you'd like to, I'd like to read to you like what I learned about this. So Absolutely. This is kind of interesting. So number one, the return of capital mechanism. So here's the breakdown of how that 11% yield is actually generated. So it says here, and I'm just reading from Gemini right now, just learning about how that yield is generated because, hey, in crypto and DeFi, if you don't know how the yield is generated, you are the yield. So we've got to know how this is generated, right? It says here that return of capital mechanism, the most direct source of the cash paid to you is often the sale of new shares. Okay, so that's not good. But let's just run through this. Strategy Inc. uses an at-the-money program to sell common stock, MSTR shares, or STRC shares at a premium to their net asset value. So that doesn't that require that if Saylor and Strategy Inc. is going to sell new shares, that those shares are actually trading at a premium to the underlying Bitcoin? Wouldn't that mean that if those shares are trading at a discount, that he would not be able to sell them to raise cash?
Well, and if I'm understanding what you're asking, it's just I think we're trying to dig into, and I apologize, I was messing with the layout a little bit, but it's how is it that they are able to pay that high of a dividend, and is that kind of what you're drilling in on?
Yeah, so I'm digging down to learn, just drilling deep on this, right? I want to figure out how are they generating this phenomenal rate of return of 11% APY? And it looks like they use an ATM, Okay, so they sell shares at the market, ATM. And it
Okay.
looks like they sell either MSTR or STRC,
Mhm.
but it looks like they do that only when the shares trade at a premium to their NAV or net asset value. So here's the process. They sell shares at the market, ATM. They raise cash. They use a portion of that cash to pay the STRC dividend. And so, because they're selling shares at the market, this is categorized as a return of capital. And it's typically not taxable for US investors until they sell their shares. So, what it does instead, according to the research here, is that it lowers your cost basis. The only thing that I would be concerned about is what happens if MSTR and STRC trade at a discount to their NAV, a discount to their net asset value. Would that
Then
then
what
mean?
happens to that 11-ish%
Right,
dividend?
right, exactly. Like if those shares are trading at a discount to the net asset value,
Huh.
then would Sailor and Strategy Inc. actually be able to sell the shares to raise the cash to pay the dividend, or not? I don't know. Um, so
That's
that's just
interesting.
yeah, just something that comes to mind as I'm reading through this. Let's see here. And then we've got three other items here. So, number two, strategies, so strategic Bitcoin reserves. So, it says here the yield is backed by the company's massive Bitcoin treasury of over 700,000 Bitcoin as of early 2026. So, the collateralization strategy Inc. maintains a dividend coverage reserve. So this, I think, is going to get to that first question that we had about what
Okay.
happens if the shares trade at a discount. So it says here, for example, they recently established a $2.25 billion cash reserve specifically to guarantee STRC dividend payments for over 2 years, even if the market turns sour. Got it. Okay, so that does answer the question, Mike, because if those shares, I think those shares might actually be trading at a discount right now. So if those shares are trading at a discount to their NAV, then Sailor and Strategy Inc. wouldn't be able to sell shares at the market to raise cash to pay the dividend. But it looks like they thought that through and they established a $2.25 billion cash reserve to guarantee those STRC dividend payments for the next
Okay.
24 months. So even though I think the shares are trading at a discount right now, they've already got the cash on hand to continue to pay that dividend for the next 24 months. So that's pretty good. But it says here also that there's liquidation potential. What? That's not good. So
I know.
so it says while they prefer not to, referring to strategy, the company, Strategy Inc., can theoretically sell or borrow against its Bitcoin holdings to ensure the monthly cash distributions continue. So it looks like they would not have to worry about anything like that for at least the next 2 years. That's a good
Mm.
thing. And then the third item here is the variable rate engine. So it says that the 11.25% rate is not fixed. It says it's a tool used to control the stock price. Man, Sailor, brilliant financial engineering here, man. I wonder why more companies haven't done something like this in the past. Maybe they have. But it says that 11.25% rate is not fixed. Instead, it's a tool used to control the stock price. So, price anchoring. If the market price of STRC drops below $100, the company increases the dividend rate to attract buyers and push the price back up. Oh, I don't know, man. That I don't know if that would actually work. And then it says here the yield spread. The goal is to offer a significant premium, currently about 5 to 7% higher over traditional money market funds to keep institutional capital flowing into the product. Okay, that makes sense. And it says here they've also got that software revenue. So isn't Strategy Inc. still an enterprise analytics software company? It says here that it generates steady, although much smaller cash flow that contributes to the company's overall ability to service its quote unquote capital stack,
Okay.
including those preferred dividends. Okay, got it. So I've got a pretty clear picture of how this product works now. And the thing that makes me comfortable with it is that they've got $2.25 billion of cash on hand to pay that dividend. But what are the shares currently trading at? Are they currently trading at par, which is that $100 STRC? I'm just bringing it up right now. Yeah, yeah, it is. But if you take a look at the chart of STRC, it's depegged a lot. Um, so I don't know if a peg is the right word to use here. It looks
Yeah.
like I think it might be though, because I'm looking at the chart of STRC, and it's right now 99.99. So $99.99
Well,
is what it looks like.
and I would guess as Bitcoin as an asset matures, and some of the volatility starts to flatten out, that it would help quite a bit as well.
Yeah, yeah. I mean, it looks to me as though, he's been able to keep it pretty close to $100. There have been brief periods where STRC has, depegged from 100, but it's pretty much it's trading for par. It's trading for $100 right now.
All
So
right. Well,
that's a good thing.
let's move on. We got about another 15 minutes in the news segment. We got just in BlackRock spot Bitcoin ETF bought $275.8 million worth of BTC yesterday. We got a whale alert of 50,160,000 USDC burned at the USDC Treasury. This is shocking. 1.7 million U.S. job cuts in the last year, 600,000 just in early 2026 alone. The government, Doge, Amazon, Intel, Microsoft, Citi, all slashing roles. AI is replacing high-income jobs. Dot-com bubble or COVID crash is next. Are we building a ghost economy? So a lot of that. I'm going to ignore a lot of that kind of sensationalism, but these figures are accurate. There are a lot of companies right now that are laying people off. They're improving their bottom line. Leveraging AI and other tools. Robotics. Amazon is big on this, and I think it's only going to gain speed. As the technology gets better and as people become more comfortable with it. If you're a company and your competition is streamlining using AI and robotics and things like that, and you're not, then you're not going to be able to compete. That's just the bottom line. So, what are your thoughts on this, David? I know we talk about AI and stuff a lot, but as it
Yeah.
pertains to jobs.
Well, I read what Jack Dorsey posted yesterday about he's just cutting his workforce at Block in half. And what's the ticker for Block? I'm curious because, Mike, when we were talking about that last night with Colin, he said that the stock pumped. So what is the ticker for Block? Block. I think it's probably like BLK or SQ. SQ. It used to be called Square. So the ticker is SQ. And let's see here. So I'm looking at the daily, and I mean, am I looking at the right thing here? SQ Square. I'm looking for Block. That's
Well,
that's what
while
I'm
you're,
looking
while you're
for.
looking for that, I'm going to name off some of these. So you got, Amazon, UPS, Intel, Nissan, Citigroup, Nestle, Microsoft, Verizon, Bosch, Dell, Accenture, Ford. A lot of these, Procter and Gamble, General Motors, IBM. I mean, there is just a ton of big companies that are doing this.
So I found the ticker. The
Okay.
ticker is XYZ, and the stock did in fact pump. And it pumped and got rejected at its 200-day moving average. But on the session yesterday, it looks like it was up from trough to peak like 26, 27%. So I think that is not going to be good for people who like having jobs because,
Yeah.
like, you know, if uh, if the entire world sees that, hey, all I've got to do for my stock to pump 30% overnight is cut half my workforce.
Yeah.
Bro, yeah, I think we're probably going to see these cuts accelerate, right? Because hey, like if you can have one person orchestrating, 30 AI agents, and that person can do the job of 30 people or 50 people, well,
Yeah.
then, these companies, man, they've got no choice but to, cut their workforces because they'll get sued otherwise. They've got shareholders. So I think that this is just the beginning. But what does this mean for stocks, though? Because here's the thing: the stocks could rip higher, man. The stocks could rip higher as everyone else gets, fired.
The, the,
So
the, the problem is right now with the way the economy is, and with inflation of the dollar, and credit card debt, and, all these different things. Nobody, not a lot of people have money to invest, except for the people that are already wealthy. And the people that do have money, they don't have enough to invest to really change their financial future. And I think that's why a lot of people are playing these speculative games with meme coins, and with betting on who's going to get investigated, and all of those sorts of things, because I mean they're basically in Vegas at the craps table, just hoping that they hit so that they can get some breathing room. Because I mean, you look at the a lot of the like credit card debts at a record high. Housing, it just flipped to where there's less people looking than houses on the market. So it's worse than it was in 2008. So the housing market potentially is a bubble that's about to burst, because if there's less demand than supply, then people are going to have to start lowering prices to attract buyers. And if that gets aggressive enough, you could see a very steep drop off in the price of real estate.
yeah, the thing that real estate has going for it, though, in the right direction, is rates are moving lower. So that's a good thing because I see
It could entice buyers, absolutely.
exactly. It makes it
But if people don't have jobs, and their debt to income sucks because their credit cards are run up, they're not going to be able to buy shit.
that's true. That's totally true. So it's yeah, you got on the one hand, you need a job to be able to buy a house. But also on the other hand, if rates for a 30-year fixed mortgage are at 7% or 6%, that's going to immediately price out many now. And anyone who wants to sell that piece of property now, they could actually do that because they'd be able to, move into a new place and not have to pay some ridiculous mortgage rate.
Yeah,
So yeah, I mean we've got both things going. You got the AI revolution really starting to accelerate and jobs starting to get lost, while at the same time you see rates pushing lower. And the thing that's worrisome for me about rates pushing lower is that if the stock market is at or near all-time highs, and we're kind of expecting like another push to the upside out of the stock market, uh, you would expect rates to go up, not down. So rates down, that means bonds and notes bid. So if you see the stock market down, bonds bid, gold bid, that's risk off behavior.
okay.
So yeah, I think we might be entering a little bit of a risk off period in markets for a little while.
All right. Well, we got this. Gold just reclaimed $5,250. So
Yeah.
a lot, and gold is considered a risk off asset. A flight to safety. Whenever markets get turbulent, a lot of big money, smart money, historically have gotten into gold and precious metals. It's a place that they, like if they feel that the dollar's in trouble, they go to gold, because gold is going to perform better against the dollar if the dollar's weak. So, again, what are your thoughts on this?
Yeah, it would not surprise me to see gold have another phenomenal year this year. The thing that I'm watching to try to figure out like where could gold head next is I'm watching the dollar. I'm watching DXY. And that's why it's
Mhm.
so
The
important that we
Dixie.
understand, yeah, the Dixie. That's why it's super important that we know like what's going on with rates. Because if rates move lower, then it makes it more likely that the dollar also moves lower. So yeah, I'm looking at the dollar right now, just clinging to trend line support. If the dollar actually breaks down and moves towards 90, then it wouldn't surprise me to see gold make a move up towards 6,000. So it's gold is getting up into that rarefied air, and it wouldn't surprise me to see that 56.25 high get taken out to the upside. Man, I'm long gold.
Yeah, no, I'm always long gold and silver. I got some of it sitting in my safe, so it's
Exactly.
it's just something that just over the years I've just stacked because I know it goes up over time. It goes up and down, but overall, the trend is if and it goes back to what we're always talking about is if you're able to sit on your hands, if you're able to stay in the asset and not have to sell it because you got you saw some shiny object that you want to buy. You want to buy a new computer or a car that's going to depreciate. If you can stay in whatever assets that you have, good solid assets, and you just sit on your hands and do nothing, a lot of times that's going to be the most profitable thing to do. You can overtrade.
100%. 100%. Yes, I couldn't agree more. Sometimes the best thing to do is nothing.
Yeah. So big banks are coming to Bitcoin. In the last 3 months, Citi launching Bitcoin custody, wallet, and key management to integrate BTC into TradFi this year. I know this makes your skin crawl, David, but let me finish.
Sure, sure. Yeah.
Morgan Stanley to launch its own Bitcoin Trust ETF, first major bank to file. Bitcoin supporting digital wallet in 2026, Bitcoin trading to launch in 2026, lending, yield, and full custody services on the way. JP Morgan, exploring Bitcoin and crypto trading for institutional clients. CEO Jamie Dimon admits he was wrong that Bitcoin is real and will be used by all. Goldman Sachs buys 1.1 billion worth of Bitcoin. CEO David Solomon announces he owns a small amount of Bitcoin. Standard Chartered launching prime brokerage accounts for Bitcoin trading. UBS to launch Bitcoin trading to select private banking clients. Danske Bank, Denmark's largest bank, announces offering Bitcoin and crypto ETPs to investors. So, what's your thoughts on all this? Because I know that we're always pointing out, don't watch the price. Price is an emotional trigger. It's the way that you're manipulated to sell low, buy high. Watch what they're doing. Watch what they're building. They wouldn't be going through and jumping through these hoops and pushing legislators to draft legislation and pass legislation, and they wouldn't be building out this infrastructure and going on chain if it wasn't the future. So, David, what's your thoughts?
Yeah, I think that all of these large institutions, really launching digital asset products this year, I think it's a net positive. It's a net positive for the space simply because it means more adoption. And I think that's probably the single most important thing when it comes to digital assets and number go up is how many more people are using these products? How many more people are buying and holding Bitcoin? How many more
Mhm.
people are trading it? How many more institutions are buying and holding it? So I think it's a net positive, um, and I'd love to see more of it. For
All right.
me, I hold assets spot, and I am sovereign. But you know what? I think it's a big, big net positive for us to get real regulatory clarity and to see these big institutions buying up, in size. It was kind of funny how David Solomon, isn't he the head of Goldman Sachs? How his bank buys
Yeah.
$1 billion of Bitcoin in a filing, and then he says, I got a small position, a small amount of Bitcoin.
It's like, yeah,
That's
yeah.
funny.
I guess everything's relative. When you're dealing in the hundreds of millions and billions of dollars, a small position, for him is probably a very large one for the average person.
Yeah, I got a couple Bitcoin. Yeah, I don't know where they are.
Just laying around. I think it's under a couch cushion or something.
I lost my keys. Does anyone know where that 12-word seed phrase is? Oh man.
I had it on a bar napkin, and I might have
Yeah,
washed it.
exactly, dude. But it's great to see the adoption, though. More users to the space. That's a net positive for sure. 100%.
Well, this is about the time where I'll be working on it this weekend. But we'll have a little transition video to move from our news segment to our kind of interview guest segment and educational portion of the show. So imagine that's going on. David, do you have a
Right.
lesson that you want to share with us today?
I sure do. Here, let me go ahead, share my screen, and we're going to hop to it. Let's take a look over here and let me see. Okay, so just want to make sure that, Mike, you can see my screen here. We're going to hop in. I think that,
After the show, stay on, David. Let's mess around and see if there's a way to maximize, whenever you're sharing, to maximize the content.
yeah, there's got to be. So let's see here. I think we left off in first crypto steps. And I think we're at lesson 4. I'm pretty sure that we got through lesson 1 and lesson 3. Why don't we talk through lesson 4, exchange wallets versus your own? And I think that this is pretty important, seeing as how all of those big institutions are buying up digital assets now. If you're going to be trading or custodying digital assets using these big, globally important banks, these GSIBs, like Bank of America or Wells Fargo or Goldman Sachs or Morgan Stanley, et cetera, et cetera. If you're going to use any of these institutions to buy, trade, custody digital assets, you don't own it. If you don't own your keys, you don't own your coins. So let's run through crypto custody and learn a little bit about exchange wallets versus self-custodial wallets. So let's check this out. Let me see if I can open this up.
Can't hear it.
Okay, so can't hear it. Let me go ahead and stop the screen share and start that back over. I had shared my audio, but let's see, it says share tab audio. So I'm just going to go in here, make sure that I'm sharing my audio, and let's try this one more time. Here we go. Let me know, Mike.
So,
Right.
you've bought some crypto. Awesome.
Perfect.
But let's ask a really important question. Maybe the most important one. Who's actually holding it? Like, who's really in control? Today, we're going to dig into crypto custody. And trust me, the answer isn't always what you think.
Okay, to really get a handle on this, let's use a super simple analogy. Picture your crypto like a really nice, expensive coat. Now, you can leave it at a coat check, right? That's kind of like leaving your crypto on an exchange. It's easy, it's convenient, but you're trusting someone else with your stuff. Or you could just keep it in your own closet at home. Yeah.
Yeah, so what happens if the exchange lends out your coat? I wouldn't be too happy about that.
It's on you to look after it, but you have total 100% control.
Unless they
So
leave
here's
their
what-
wallet in it.
I know, right? And your car keys, maybe.
Yeah. If you leave your seed phrase in there, yeah, you can borrow my coat.
Yeah, no, thank you.
On top, we're going to start with this whole coat check problem, then get into the most famous saying in all of crypto. After that, we'll weigh the options, look at a really smart hybrid strategy, and wrap up by figuring out how you can make a plan that works for you.
All right, let's really get into it. This coat check problem basically boils down to 2 main ways you can hold your crypto. It's one or the other.
So the first way is what we call custodial. This is exactly what happens when you buy some crypto on an exchange and just leave it sitting there. You think you own it, and you do, on paper, but here's the kicker. They hold the private keys. They're the coat attendant, holding on to your valuable coat for you.
And the other option?
That's self-custody. This is where you actually move your crypto off the exchange and into a personal wallet that you and only you control. You have the keys. You are literally your own bank. And in our analogy, yep, you're putting that coat safely in your own closet. And this right here, this is a huge distinction. When you look at your balance on an exchange, you're not actually looking at your crypto. What you're seeing is an IOU. It's just a promise from the exchange that says, yeah, we owe you this much. But when it's in your own wallet, that's not a promise. That's the real deal. It's actually yours, under your control.
Right. So this is super important to understand, Mike. Like if you own your own assets, these digital assets, they are bearer assets. All that means is whoever owns the keys is the bearer of those assets. They can move them, they can spend them.
Well, it's like the old bearer bonds. I know probably a lot of people don't. It's kind of old school because they stopped producing them, but there still is this thing called a bearer bond from back in the day, and they're basically like this big sheet of paper, like a certificate, and you can whoever holds those, it holds its value. So it's almost like a extinct currency that's still honored.
Yeah, if in my opinion, the digital bearer assets, it's best to self custody those assets because if you
that's
hold them,
basically the bearer bonds. That's basically what it was. Is it was kind of the OG Bitcoin, where it's not tied to any government, it's not anchored to any fiat. It's basically you could have a stack of those. DeFi Don in the chat says he has about $50 worth, but you can go anywhere and you can exchange that for for the value that whatever the face value is.
right? You remember, like Die Hard, the villain
Yeah,
in Die Hard, he
yeah,
wanted like $50 million in bearer
and
bonds,
unmarked bearer bonds. Yeah,
right?
yeah, yeah.
Right. And he wanted those bearer bonds because whoever is the bearer of those assets can spend them
And they
or
can't be
transfer
tracked.
them. Right, right, because it's just a piece of paper.
Yeah.
That's what it is. But in the digital asset space, all of these digital assets are bearer assets as long as you
Is
own your
your self
keys.
custody. Yeah,
Right.
as long as
You
you
got it.
have self custody.
Exactly. If you've got it on an exchange, all you have is an IOU. And if the bank
Well, and
decides,
my brother who's new to crypto, and I got him, got him to buy some Bitcoin. He's almost a 1 Bitcoin holder now. He called me in a panic about a week ago. He's like, I just watched something on TikTok that says "not your keys, not your crypto." What does that mean, dude? And I was like, hey, if you got it on Coinbase, what you see on your screen is an IOU. You don't own that. You have to put it in a cold storage wallet to truly own that asset. If they go bankrupt, then they can use that to make their investors whole, and
yeah,
you get locked out. It's that's tied up in bankruptcy court for who knows how long. So he's like, he started to hustle to get himself a cold storage wallet, but that's why these lessons are so important is you need to understand these nuances. But go ahead.
yeah, 100%. So if the bottom line here is that if you've got assets on an exchange, it doesn't matter if that exchange is, Coinbase or Binance or Goldman Sachs or Morgan Stanley. If you've got digital assets on an exchange, you don't own anything. You've got an IOU. If you have those same digital assets in your wallet, then you have custody of them. You are the bearer of that asset. Really
Well, and
important to understand that.
it's the same thing with your cash in the bank.
Right.
The bank can basically cut off your account. They did it to Trump. They've done it to a bunch of people. They did it in Canada to the truckers. Cut them off from their bank accounts. But the difference is if you have cash in your hand, you can go to somebody and you are in control. It's a digital version of holding cash or gold or something else that you can hand to somebody physically. You are in
Yeah.
control.
Yeah, and you need to be in control because, the two examples that you just gave, Mike, of the truckers in Canada and, President Donald Trump having their assets frozen, essentially, it turns a bank account into a weapon of control. Because I think most people will say something like this: oh, well, that'll never happen to me. The bank will never freeze my accounts. Well, try having an unpopular political opinion in a regime where the people in
China,
power are, yeah,
China.
you know, like, good luck with that. Yes, they will freeze your account. Yes, they will use your bank account as a weapon against you. And they'll do that to control either your speech or your movement or both, or
Well,
what you can
and we
buy.
talked about that last night on the red pill. We kind of opened up on the topic of CBDCs, digital IDs, all of those sorts of things, and CBDCs is central bank digital currency. It's basically a controlled currency that they can turn your money on and off, like David's talking about. If you say the wrong thing, do the wrong thing, if you're deemed not if you're not towing whatever the line is. And this is that UN initiative. I think it's a initiative like 2030 or something like that is what the lady was saying, where the UN is basically trying to make digital IDs attached to CBDCs and everything else, so that it's a lever of control, but it's under the guise of inclusion and what was the other one? Inclusion and
Equity.
equity.
Yeah.
So yeah. Anyway,
Yeah, whenever you hear those two words, inclusion and equity, oh man, run in the opposite direction. Those are bad words.
yeah.
I know this whole idea of trusting someone else with your assets, well, it leads directly to the most famous saying in the entire crypto world. And believe me, it's not just some catchy phrase. It's a lesson that was learned the hard way, written in the language of billions and billions of lost dollars. And don't think this is just some theoretical risk. It's happened over and over again. I mean, look at this. Back in 2014, Mt. Gox gets hacked, 850,000 Bitcoin, poof, gone. Then in 2019,
Can you imagine, Mike? 850,000 Bitcoin. So, yeah, that's basically like an entire Michael Saylor strategy going poof overnight. Just unbelievable, man. And
Oh
Mount
yeah.
Gox, yeah, dude, Mount Gox used to be a Magic the Gathering server.
Well, it's crazy to think about, how this has evolved. Because I mean, again, I remember back in what was it, 2011, like 2011, 2012, when my buddy first told me about Bitcoin. But the crazy thing is, like, people were using like old laptops and mining, like tons of Bitcoin. I mean, just again, hundreds and thousands of Bitcoin, because it wasn't worth shit, and nobody was mining
Right,
it. And
right.
so it didn't take a whole lot of compute. And but of course, as time went on, it became more valuable. Then you got people building massive warehouses full of miners. But back in the day, there's that story of the guy that was like, I forget what he paid, but it was like 10,000 Bitcoin if somebody brought him a pizza. That
Yes.
that whole story. And dude, I mean, can you imagine, being that guy where it's like you paid 10,000 Bitcoin for a pizza, and I mean that 10,000 Bitcoin is worth what, like $68 million right now, or $64 million or some shit.
Yeah, man. I mean, oh my goodness, dude.
That better have been a kick ass pizza, dude.
That's it must have been the best pizza ever. Yeah, he must. I'd feel pretty silly if I were that guy. But my goodness, man, look what happened in 2019, though. So, Mike, you know how they say that you can't take it with you when you die, right? You can't take the money with you. You better, do something with it now. Well, this guy proved us wrong. He took it with him. The CEO died, and maybe he had that seed phrase, just he memorized it in his head. Well, he took it with him. Man.
you have the CEO of Quadriga CX who disappears, taking access to $190 million with him. And who could forget 2022? The
Disappears.
total collapse of FTX.
Yeah, exactly. Wow. But I don't think the funds moved. So, he disappeared, potentially murdered, who knows? But I don't think the funds ever moved.
It's just pure fraud, wiping out billions in customer money. In every single one of these cases, people who left their coins on the exchange found out their IOUs were, well, completely worthless.
Yeah, sometimes you F around and you might find out.
So yeah, that whole history of disaster, that is exactly where this phrase was born. Not your keys, not your coins. It's just a simple, stark reminder that if you aren't the one holding the keys, you're basically just hoping and praying that someone else doesn't lose, screw up, or get robbed of your money.
Okay, so with all these huge risks out there, what's the right move for you? Look, it's not as simple as saying one way is always good and the other is always bad. It's really all about understanding the trade offs and figuring out what makes sense for your specific situation.
Let's break this down side by side. On one hand, you have exchange custody. It's honestly great for beginners for small amounts or if you're trading a lot. But the big scary risk? The exchange itself could fail or get hacked. On the other hand, self custody. This is the way to go for larger amounts or long term holding. But now the risk is all on you. If you lose your keys, that crypto is gone forever. It really all boils down to that last point. Who is in control?
Now, even with that terrifying history lesson, don't get me wrong, there are absolutely good reasons to use an exchange. I mean, they're the easiest way to turn your regular money into crypto. If you're just playing with small amounts you can afford to lose, or you're trading all the time, or you're just dipping your toes in, the convenience is probably worth it. A good way to think about it is like your crypto checking account.
But
So, I would actually disagree with that point because if you're just getting started in the digital asset space, it's probably a good idea to go through all of the educational material that has been published over at DeFiUniversity.xyz and build a skill set so that you can start with really small amounts in DeFi and in crypto. So you can buy a small amount of spot Bitcoin and self custody that spot Bitcoin so that you can buy maybe a small amount of ETH or a small amount of Sol or something along those lines and learn how to use a hardware wallet to self custody your own assets. So, although for many people, starting off on an exchange makes sense simply because, as we were talking about last night, Myke, the on ramps and off ramps remain a choke point. So, if you're going to have to on ramp from fiat into stables or from fiat into Bitcoin using an exchange, well, then maybe as you're just getting started, you use an exchange account. But in my opinion, it's probably better just to use that exchange account to on ramp into cash, into stables, and then use those stables to swap in to the assets that you want to hold in your self custody hardware wallet. Learn how to do that when the amounts are small so that when the amounts are much larger, you know what you're doing. So I would actually start small in self custody first. That would be my recommendation.
And that's why it's always smart to do like small test transactions, even when you get experienced, because you can get complacent. Even when you get experience and you're very proficient, sometimes you can be, go a little too fast, click the wrong button, fat finger, an entry, whatever. You should always have a checklist whenever you're sending, crypto, anywhere. You should always double and triple check the address. I always check, the first five and the last five. You can check more than that. There's, when you're copying and pasting, especially because there's exploits that take advantage of that. You always want to send a small test transaction. Send like $1 or $2. Make sure it goes through. Once it goes through, okay, now I'll send the main amount. All of these are, good habits to get into. These are what's called best practices. And if you can have that checklist and have the discipline to always stick to it, don't let yourself get emotional. If you're getting some FOMO and you're hurrying and trying to get it to a decentralized exchange so that you can do some DeFi and you're thinking you're going to miss out, take a breath,
right? Yeah,
and slow down.
Yeah, exactly. Whenever you feel that FOMO, whenever you feel any type of emotion around investing or trading, I think it's probably best to just get up from the computer, go do something else, touch grass, look at the sun, get some sun, whatever, but get away from the screens. You don't want to be investing or trading when you're experiencing any type of emotion. You've really just got to be like almost dead inside. Like you gotta have nothing going on inside, man. You can't have any emotion.
You just got to go through a bear market, and trust me, you'll be dead inside.
There you go.
Watch write everything, do a round trip with your crypto, and you'll be dead inside. If you're still in crypto, whenever you see pumps, like when I see pumps now, I'm like, it'll go back down. It's like,
Yeah, man. When you're actually like actively trading, you have to be unemotional. So if you ever feel like a FOMO and you can't buy big green candles, you can't do it.
well,
Checking.
and all the best traders, say exactly what you're talking about is when everybody else is bullish and everyone else is buying, you should be selling. When everyone else is selling because they're panicking, you should be buying. If you want what the masses have, do what the masses do. If you want to get wealthy, do what the wealthy do. It's a really small and simple life hack. Is find somebody that has what you are looking to achieve, align yourself with them, have them mentor you. So, and because that's the fast track, don't make the mistakes, learn from somebody else's mistakes. But
100%. And what quote unquote smart money likes to do is wait to buy until, all the blood is in the street, so to
yeah,
speak. Wait until there is depression and then swoop in and buy everything you can get your hands on and then do nothing. Wait. And then when markets inevitably rebound and at the top, everyone is saying, "Oh, I've got to buy because it's going to the moon, don't you know?" Well, that's
sell,
when
sell, sell.
exactly. You sell, 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 right?
But the second that amount starts to feel significant to you, or you decide you're holding on for the long term, hodling, as they say, then the argument for self custody gets really, really strong. This is more like your crypto savings account. It's about taking that personal responsibility and putting a lock on your long term security.
Okay, but here's the best part. This doesn't have to be a black or white, all or nothing choice. In fact, probably the smartest strategy for most people is a hybrid approach, where you kind of get the best of both worlds. A ton of experienced crypto folks use this really simple 3-step process. So, step one, you use the exchange because it's easy, right? That's your on ramp to buy the crypto in the first place. Step two, as soon as you buy, you move the bulk of it over to your own secure personal wallet. That's for safekeeping. And then step three, you just leave a little bit, a small active balance on the exchange in case you want to make a quick trade.
Okay, so when you buy a digital asset using either fiat or stables on an exchange, that exchange is going to report. So it might be a better idea to control how that is reported by swapping in from fiat to stables and then sending those stables to your own hardware wallet. And then you can use a decentralized exchange to swap those stables for the digital asset that you want to purchase. So I think that that's probably the better route than just buying on an exchange. So
Well,
This
and
strategy.
that's a great point, David, because I know like with Coinbase, we always talk about, you can onboard your fiat for zero fees, for free. You can move it to a cold wallet or, an external wallet or a decentralized exchange for free. And then it's a lot cheaper to swap it over on some of these decentralized exchanges or on some of these swaps than it is that you're ever going to find on a centralized exchange. So it's a better way to buy your crypto that way.
100%. It really is because all of these exchanges, part of the way that they make money is through what's called a spread. And so that spread is the difference between the bid price and the ask price in any market. So if you want to buy Bitcoin and you want to do so on Coinbase, well, you're likely going to pay what's referred to as a Coinbase premium, which is simply the spread between what the asset is currently trading for spot and what Coinbase will sell that asset to you for. Coinbase is
Yeah.
going to take a little bit of a premium.
And it's even, I don't know if you can see it, but I mean, this is gold and silver and precious metals. I mean, they have a bid or an ask price and, as well. So, it's basically what they are willing to buy it off you for and what you have to pay to buy it.
Exactly.
There's a difference, and that's the premium that he's talking about. Because when you buy or sell gold, there's a premium. it's you have to pay more for it when you're buying it, and they're going to buy it off you for less than spot.
Right. And so that's how the exchange or the broker, if we're talking about gold and silver, or the exchange, if we're talking about digital assets, that's part of how they make money, is that spread on any purchase or sale.
Trade. And this strategy is so smart because it gives you that perfect balance. You get the easy buying of an exchange, the Fort Knox level security of your own wallet, and the flexibility to trade. It's all there, and you've massively cut down your risk of losing everything if an exchange goes belly up.
Right.
All right, so let's bring it all home. Now that you've got all this info, you can actually start to put together your own personal plan. You can decide what level of risk you're okay with and how much control you really want. Let's do a super quick recap of the most important stuff. First, exchange wallets aren't your coins, they're IOUs. Second, your own wallet means you have real, actual control. Third, that saying, not your keys, not your coins, comes from a very real, very painful history. And finally, number 4, the best choice here is all about you, your goals, your timeline, and what you're comfortable with.
So I want to leave you with one final thought. Let's say you have $200 worth of crypto, and you plan to hold it for a long, long time. Now that you know all this, what do you do? What's your play? Do you leave it on the exchange because it's easy? Or do you take that extra step and move it to your own wallet for that maximum security? Seriously, think about it. Your answer to that simple question is the first real step to building your own custody plan.
Yeah, so this is actually a pretty decent question right here. So if you've got $200 for long-term holding, what do you do? Well, start when the amounts are small. You've got to learn the skill set so that when the amounts get big, you know exactly what to do. So I would start
Develop
with
good habits.
exactly, man, exactly. Like if I was just starting out with $200, I would 100% be buying Bitcoin. That's what I would do. And I would self-custody that Bitcoin. That is what I would do to get started in the digital asset space. I would buy $200 of Bitcoin and self-custody that on a hardware wallet. That is what I would do there. So let's take a look at this. We've got that exchange wallet versus the self-custodial wallet. If you've got assets on an exchange, you have an IOU. If you own your assets because you own your keys, then you own that bearer asset. You own that digital asset. You've got full control, but it's also your responsibility to keep it safe. So that's a really important concept there, that idea of sovereignty comes with a lot of self-responsibility. So you got to just make sure that you are responsible enough to custody your assets safely. Now, if we take a look at this little coat check analogy here, if you're basically handing over your keys to an exchange. The exchange is going to give you an IOU. You walk away with that IOU, and as long as you trust that exchange, okay, maybe it's okay. But we've seen, over the last 10 years, how many of these exchanges have, turned out to be frauds or gotten hacked, or, the CEO dies and he's the only one with the keys, or you name it, So if you've got an IOU, you don't actually own anything. That's just really important to understand there. Okay, so let's go ahead and move on to module 2. And we've got only 6 minutes left. So we might actually be able to get through this entire video content here in 6 minutes. Understanding crypto addresses. So this is going to be a little bit more of an advanced video here. Maybe we're going from beginner to just a little bit less beginner, but you've got to be able to understand these addresses. So let's take a look at this.
All right, let's talk about something that is absolutely critical in crypto, the wallet address. Honestly, if you get this part right, you're set. But if you get it wrong, well, that's exactly what we're going to break down today. So what even is a crypto wallet address? The best way to think about it is really simple. It's pretty much just a mailing address, but instead of for letters, it's for your digital money. It's this unique string of characters that tells the whole blockchain, hey, send the funds right here.
Okay, but here's where that mail analogy gets kind of terrifying. If you mess up a physical address, the letter usually just comes back to you. But in crypto, there's no post office, no central authority to fix a mistake. There is absolutely no return to sender. It is a one-way trip.
And this right here is probably the single most important rule.
Dude, look at this coin. Look at this image, man. Oh my goodness.
He looks very scared.
I know. Is that a blender or a shredder? What is that?
I have no clue.
It looks like a shredder, man.
Crypto. Transactions are final. They are irreversible. If you send your crypto to the wrong address, and I mean even by one single tiny character, those funds are, for all practical purposes, gone for good. The stakes are incredibly high.
So to make sure that never ever happens to you, let's really dig into how this whole digital mailing address thing actually works.
When you see it laid out like this, side by side, it really clicks, doesn't it? Your home address has a street, a city, a zip code, familiar stuff. A crypto address is just this long, kind of intimidating string of letters and numbers. Mail gets sent through the post office, crypto gets sent on the blockchain. But look at that last line. That's the game changer. Cannot be returned. Now, to make things just a little more interesting, not all addresses are built the same. You know how different countries have totally different zip code formats? Well, different blockchains have their own unique address styles. You can't just send a Bitcoin to an Ethereum address and hope for the best. It doesn't work that way. And you can actually learn to spot these differences pretty easily. Take Ethereum, for example. Its addresses will always start with 0x. A modern Bitcoin address, you'll often see it start with BC1. Just knowing these little clues gives you a super quick way to double check. Like, wait, I'm sending Ether. Does this address start with 0x? It's a fantastic first line of defense. Okay, now let's zoom way in to see just how careful you need to be. We're not talking about mixing up the street name. We're talking about one single character. Let me show you an example that'll make you never want to type an address by hand again. All right, take a good look at this Ethereum address. Just kind of burn the first few characters and the last few characters into your brain for a second. You got it? Okay, now here's another one. I mean, at a quick glance, it looks pretty much identical, right? Our brains are just wired to skim over these long, random strings of text.
So I'll pause for a beat. Are they the same address? Look really, really closely, especially at the very end. This is one of those moments where a tiny detail can cost you everything. And there it is. Did you catch it? The very last two characters are flipped. 08 switched to 80. And that one tiny change doesn't just create a typo, it points to a completely different digital mailbox somewhere out there in the world. Sending your funds to address B means they are gone. Poof, vanished. This is exactly why we never, ever manually type an address. Okay, I know, that's the scary part. So let's get to the empowering part. How do we make sure this never happens? Well, luckily, there's a super simple playbook, a safety protocol you can just follow every single time. But first, you have to know about one more nasty little threat out there. It's called clipboard malware.
This is what you were talking about, Mike.
Yeah.
It's the sneaky software that hides on your computer, and the second you copy a legit crypto address, it secretly swaps it with a scammer's address in your clipboard. So when you go to paste, you're pasting the wrong one. This is why just copying and pasting isn't quite enough.
And so I actually got earlier this morning a scam phishing email from someone trying to phish me on Ledger products. So not only do you get, you've got to be on the lookout for malware on your machine, you've really got to be looking out for those phishing emails. Never click a link in an email ever.
Ever.
So here it is, your unbreakable 3-step mantra. Step 1, always copy and paste. No exceptions, never ever type. Step 2, after you paste, you have to visually check the first few and the last few characters and match them to where you copied from. This simple check is what beats that clipboard malware. And finally, step 3, if you're sending a large amount, anything that would make you nervous to lose, send a tiny test amount first. Think of it as a small fee for total peace of mind.
Okay, so let's lock all of this in. We'll do a quick final safety check to make sure it all sticks.
Remember, your address is a one-way destination. A mistake? Wrong address, wrong network, it means permanent loss. So what's the playbook? Never type it out. Always copy and paste, and always verify those first and last characters after you paste. And, of course, for any amount that matters, that small test transaction is your absolute best friend. At the end of the day, your crypto security isn't just about a fancy password or a piece of hardware. It's in your habits. It's about being careful and deliberate every single time. So the question to ask yourself is, now that you know the rules of the road,
Is your next transaction going to be checklist ready?
I certainly hope so. You don't want to send your crypto to the wrong wallet address or poof, it's gone. And there's nothing you can do to recover it. There is no, customer service line that you can call to get your crypto back. Send it to the wrong address and poof, it's gone.
Yeah. So no, it's definitely, again, make sure that you're developing good habits, because if you're you can develop poor habits too. If you're doing the wrong things repeatedly, or you're letting yourself slip, and because of emotion and FOMO and lack of discipline, slowly you're going to develop those bad habits, and eventually it's going to bite you. So those simple steps that were it was just showing, you can copy and paste, but verify the first 5 or 6 and the last 5 or 6 digits, or characters, and always send a small test transaction, 50 cents, whatever you're comfortable with. Make sure it goes through. Once it goes through, then send the full amount.
100%. Yep. That's a really good best practice, just to make sure that you're sending those assets to the right place.
Absolutely. Well, so this is our last 1-hour show. Come Monday, we are going to start our 2-hour format, and we'll have probably have Taylor and Jeff on as our guests. The co-hosts of Money Talks. We kind of discontinued that one, so we're going to have them on as guests whenever they're available. And tonight we have Crypto and Chill. And we're going to be going over any new news when it comes to the Aerodrome platform and the new Aero token that's coming up. So make sure to join us for that at 5 p.m. Pacific, 8 p.m. Eastern. And I think with that, David, if you could stick around after, we can touch on a couple things. But other than that, thank you all. And until next time, Veteran Crypto out.
Peace.